Hello and welcome to MyFinanceTeacher.org. Let's have a look today at a couple of largest gold miners in the world. Those are Newmont and Barrick. And as you see from this post at MyFinanceTeacher.org back on 17th of November, we already looked at the valuation of several largest miners over there and a few more relatively large miners on the 23rd of November. So for more details, you're always welcome to join us at MyFinanceTeacher.org. Today we're just going to focus on the Newmont and Barrick, and the valuation factors are, as usual, the gold and silver prices, the reserves and resources in the ground, the costs of extracting those reserves, the company debts, taxes. Of course, we're going to look at the value per share, so we factor in number of shares outstanding. We'll look at the discounted valuation with a 5% discount rate, and I also factor in insider shares, as larger insider participation is a good sign. We're going to look at three scenarios for valuation. The conservative, where gold price generally averages around $1,600 over the next couple of years. Balanced, where gold price averages around $1,900 over the next couple of years. And optimistic, where gold price averages around $2,200 over the next couple of years. And this sort of fundamental valuation would generally work out in the longer term, as in the shorter term, the technicals on the chart might actually bring the valuation quite far away from these fundamental values. So looking at the reserves and resources, Newmont has nearly 90 million ounces in proven and probable reserves of gold and nearly 70 million ounces in measured and indicated resources of gold. If you look at the company reports, the proven and probable reserves are actually a little bit larger. So what I factor in here is the production during the first 9 months of 2021 so far. The reserves of silver are nearly 590 million ounces, and the resources of silver are around 480 million ounces. Similarly for Barrick, the reserves of gold after production in 2021 so far is nearly 65 million ounces. The resources of gold are 92 million ounces. The reserves and resources of silver make up 140 and 850 million ounces. All-in sustaining costs, as per updated guidelines for 2021, are $1,050 for Newmont mining and $995 for Barrick Gold. Long-term debts are $5.6 billion for Newmont and $5.1 billion for Barrick. In regard to taxes, I just assume a 20% tax so as to simplify things and economize on time. Looking at the discounted value per share, we're going to use a discount rate of 5%. The number of shares outstanding for Newmont is over 797 million shares with 0.11% in insider hands. And we're going to apply the discounting for the mine life, which is 15 years looking at the reserves and 21 years looking at the reserves and half of the resources. For Barrick, the number of shares outstanding is 1.78 billion shares with over 0.5% in insider hands. So that's a relatively positive sign here. And the mine life is 14 years for reserves and 24 years for reserves plus half of the resources. And the mine lives are calculated at annual production based on the 2021 guidance. So ramping up the production in future would reduce this mine life, reduce the discounting period, and improve the discounted value. Now, before we look at the valuation in these three scenarios, let's have a look at highlights that don't actually enter into the valuation calculations, into the model, but are worth considering and perhaps bumping up the valuation by 1 or 2 percentage points. First of all, both of these miners have huge amount of cash at 4.6 billion and 5 billion, which is a good sign. We don't want these large miners following the steps of Goldcore. That was one of the largest miners in the world a couple of years ago and has since disappeared due to a liquidity crisis. Both of these miners also have a great exploration potential. There is a high likelihood that the reserves and resources are likely to be expanded over the next couple of years, improving these valuations. And besides gold and silver, Newmont also has copper, lead and zinc reserves, whereas Barrick has copper reserves in addition to gold and silver. These base metal reserves don't enter the valuation either, so perhaps it's worth bumping up that valuation by just a tiny bit. And talking about some of the upcoming drivers, Newmont will have production start at a couple of their projects at Tanami in Australia and in Ahafo North in Ghana in the first half of 2024. So this might be a driver to perhaps improve the company's standing and share prices. And for Barrick Gold, in first quarter of 2023, they expect a production growth from Pueblo Viejo in Dominican Republic. I see there is a typo here. That's Dominican Republic. Finally, let's have a look at our valuations, starting with the conservative valuation, which plugs in the gold price of only $1,600 per ounce and which considers only the proven and probable reserves of gold and silver, without including any of measured and indicated resources, never mind inferred resources. So this is a relatively conservative valuation, showing over $33.50 for Newmont and over $11 for Barrick Gold. Now let's compare that to the prices as they closed on Friday. We see Barrick closed at $19.38. So there's probably around 40% risk or so in case if gold prices just drop out of bed over here all the way down to $1,600. And Newmont closed on Friday close to $56. So there's also something like 40-45% risk in this conservative scenario where gold price drops quite a lot. Looking at the balanced valuation, with gold price at $1,900 and still only looking at proven and probable reserves without including any of the measured and indicated resources or inferred resources into the model, we see the Barrick valuation is pretty close to the market price at around $54. That's just a couple of dollars below the price right now. And similarly, Barrick is also just a couple of dollars below the price, with the valuation at over $17.50 per share. Let me first welcome you at MyFinanceTeacher.org, which is a community of like-minded investors where I make regular updates on a range of markets, including precious metals, cryptocurrencies, stock market indices, energy, including uranium and fossil energy, as well as commodities such as copper, grains, and others. One of the interesting products in the community is the model portfolio, which is transparent, showing all of the history of my trades starting in July 2020, with the total gains without any leverage, so that's without taking too much risk, is around 55% between July 2020 and October 2021. With a 2x leverage, one perhaps could double the portfolio size in the same period. So if you want to see what's going on in the investment community, you are more than welcome to register. And lastly, and most excitingly, let's have a look at our optimistic valuation, where gold price averages around $2,200 per ounce over the next couple of years. And in this valuation, we include all of the proven and probable reserves. And even though it's an optimistic valuation, we only include half of measured and indicated resources, without including any of the inferred resources. So even our optimistic valuation is not really pointing sky high with our expectations. So in this case, the value of the reserves and half of the resources in the ground, after production costs, after debts, after taxes, give us a discounted per share value for Newmont at over $93 and for Barrick at over $35. So it looks to me that if gold price goes back to some of the recent highs from summer 2020, above $2,000, there is still a pretty good chance that these two largest miners in the world will perhaps nearly double in their share prices. At least that's what the model tells me, but what do you think about it? With gold prices close to $2,200, where do you expect Newmont and Barrick? Let me know in the comments below. While you are there, remember to hit that like button, I would really appreciate that. Subscribe to the channel so you don't miss my regular content, and have a pleasant weekend.